Hi, so today's video is designed to go through all the key points that I'm asked about moving property into a limited company and to run through the basics and the implications of doing so. So, by way of a brief introduction, my name is Carrie Stokes and I'm the founder and director of Spotlight Accounting. Now, we specialise in property. The reason that I'm a property specialist is because we have our own portfolio outside of Spotlight Accounting with a mix of properties that we're currently trying to grow and make more investment into. We also have a history of property renovations, so as I have walked the walk, property tax is a real interest of mine to making sure personally I'm as most tax efficient as possible. By way of a disclaimer, this does not constitute specific tax advice to anyone, and it is being recorded in June 2024, so it is based on the legislation that was in force at today's date. We're due for a general election, so this could all change. So, by way of a brief background, there are three key changes recently that is causing a perfect storm for landlords, and it gets into the point where portfolios are actually costing more money in tax than profits. So the first key sort of change within landlord taxation was the introduction of Section 24 in April 20. Section 24 is where interest was no longer a cost of the property for taxation, and instead of going against the profits, a 20% tax relief was given. And what has happened is it has pushed a lot more rental income into the 40% tax bracket. So a lot of landlords are being taxed on rental income at 20%, but only getting 20% interest relief. Then add to that, in April 22, the government decided to freeze the income tax thresholds. So at the moment, total earnings up to the 40% threshold is 50,270. That should obviously have been increased with inflation. So again, landlords are being taxed a lot more at higher rates. Then the icing on the cherry has been the increase in interest rates. And this increase in interest rates is severely impacting a lot of landlords, to the point that they are paying more in tax than the profits on their property portfolio, which is why a lot of landlords are looking at how to make their investments more tax efficient and potentially incorporate into a limited company. So some people have the terminology SPV. So what is an SPV? It is a form of a limited company, and that limited company's purpose is to hold property. Now, when you incorporate a limited company, you have to give what is known as a SIC code, and you need to make sure that the correct SIC codes are in place to enable that company to purchase property. A limited company or an SPV is a separate legal entity to yourself, so you have to think of it as having a separate birth certificate. You also will become, in most cases, a director and a shareholder of the SPV. Now, directors, in effect, are the parents of the company. They are responsible for making sure the company can meet all its obligations, file the accounts that companies have enough working capital to pay all their bills, and are trading solvently. Now, the directors are responsible for running the company for the shareholders. They may be the same person, but directors still have a legal duty to make sure that they adhere to all their compliance requirements. So, how do you get your properties out of personal ownership into a limited company? Because of having, in effect, a separate birth certificate and being a separate legal entity, you physically have to transfer or sell your properties into the limited company. Now, where a limited company has shareholders and directors that are connected to the people selling the property. So, for example, if you're a landlord, husband and wife, typically you would own all your properties and you'd be transferring them into a limited company that you both own. Because you are connected, all the transfers have to be done at market value on what is known as an arm's length transaction. So you can't gift the properties into a limited company. If you do, the transaction is still deemed to be held at market value. There are also implications when you have your children as shareholders as well. There is incorporation relief. So incorporation relief, in effect, is a way that you can transfer your property portfolio into a limited company tax-free. There's no capital gains tax and there's stamp duty exemption. This has been tested in court in the Ramsey case, and you have to prove that you are working on your portfolio 20 hours a week to qualify for incorporation relief. If you're a husband and wife partnership, that means 40 hours between you both. If you don't work those 40 hours, you will not qualify for incorporation relief. There are other methods using an LLP with corporate partners, but they are now known tax avoidance schemes. So if you do not work in your portfolio for more than 20 hours, incorporation relief will not apply. And again, this has been tested in court, so you cannot, it's not a grey area, it is black and white. So please remember the 20 hours requirement. If you don't meet it, don't try it, because it is now case law. So what taxes are involved with moving a limited company if you don't qualify for incorporation relief? Well, firstly, there's capital gains tax. Capital gains tax is the difference between the value of the property now and what you purchased it for. Now, at the moment, the higher rate of capital gains tax has been reduced to 24% from 28%. There's also stamp duty to pay. And again, going back to the connected persons, it needs to be at market value. So if you are disposing of a property that's worth 120,000, the stamp duty payable on that transfer is based on the £120,000. Multiple properties relief has been abolished now, so it is a case of market rates. So what are the tax savings involved in being a limited company and having your portfolio within a limited company wrapper? Well, firstly, you get full interest relief. So if your rent is £10,000, your cost is £2,000 and your interest is £2,000, you pay tax on the £6,000, all at the same rate. Secondly, corporation tax tend to be lower than personal tax rates, especially if you've got a large portfolio. Part of your portfolio would definitely be taxed at the 40% rate when you're only getting 20% interest. Worst case scenario, corporation tax is currently at 25%, but if your property portfolio profit is less than £50,000, and you've got to remember mortgage interest gets deducted at that, the rate of tax is at 19%. The other key tax saving is flexible extraction. So your portfolio makes a profit. With a limited company, you have got the flexibility of how you extract that profit. You can leave it in to reinvest in other property. You can extract through dividend, through salary, and you can look at putting contributions into your pension scheme. So there is a whole raft of planning that can be done around having a property portfolio in a limited company. If you hold it personally, whatever the property portfolio makes, that is what you are taxed on. There's also inheritance tax planning opportunity. You can move a SPV into a family investment company, and there are ways of introducing the children in a tax efficient manner. Not for this video, and maybe for one in the future. So the question that everyone asks is, should my portfolio be in a limited company? And the answer is always, that depends. And there are a number of factors that need to be considered before you make that decision. The first one being the profits of the property business. So for example, if you have no other income than your property portfolio and it makes £20,000 a year before the interest relief, then it is not worth you incorporating the property portfolio because you're a basic rate taxpayer. That may change with new tax rates and allowances, but for now that we would recommend. Next would be any other income. So again, it depends on what your other earnings are as to the tax savings you would get from incorporating your portfolio. The value of the property portfolio, that obviously impacts on the capital gains tax payable, but also any potential inheritance tax planning opportunities. Tax reliefs that are available to your personal circumstances. So for example, you might have a huge capital loss that can be offset against any capital gain on the move of your property portfolio. So again, that would make it more incentivized to incorporate into an SPV. Also again, you might qualify for incorporation relief providing the government don't change any legislation with regards to that. The original purchase price of your property portfolio. So again, the smaller the difference between the value of it now and what you purchased it for, the lower the capital gains, the lower the cost of transferring into a limited company. The other costs involved with transferring property into a limited company. So in most cases what will happen is the landlord will refinance all the properties to pay for the tax and the stamp duty involved in the transfer. And again, the interest on mortgages for properties in limited companies can be at a higher interest rate than those on properties that are personally owned. The ongoing costs of running a limited company. Accountancy fees alone can be from £600 a year, and the bigger the portfolio, the higher the accountancy fees are. And you will still, if you're pulling dividends out of the property company, have to submit a personal tax return as well. And what your future plans are. So you might have one property now, but be looking to grow a portfolio of 20, 30 properties. So again, it is not just looking at the tax savings now, it's looking at your long-term plan for your investment. So what are the advantages of putting your property portfolio into an SPV? Firstly, the tax savings. If you're a higher rate taxpayer, corporation tax is a lot lower than the personal tax and you'd be paying on your property income. Secondly, the flexibility. You can pick and choose how you draw income out of your property company. Okay, you pay corporation tax on the profits, but how you extract that value personally, or whether it remains in the business to invest in future purchases, it is down to you. Whereas as a personal taxpayer, you pay tax on the profits, whatever they are for that year. There is also inheritance tax planning opportunities. So again, there's the opportunity to bring children into the SPV and make it a family investment company. This is not for this video, but there are opportunities so that you minimise your inheritance tax liability. The disadvantages of having an SPV. Well, firstly, it's the cost of incorporation. Not only have you got the cost of setting up the business, you've also got the cost of moving the property. So that is legal fees, stamp duty, capital gains tax, and all the associated fees with refinancing your property portfolio. This is the remortgage, so it's the actual time and effort going into remortgage all of your properties. And you might not even have to remortgage all of them. And again, if you've got a large portfolio, it might be that you leverage on one property to make the transaction easier rather than having mortgages over a number of properties. Personal use. So we have a lot of landlords that might be renting out one property in their portfolio that they've got their eye on to retire into when they downsize. If you move that property into a limited company, again, going back to the separate legal entity, so it's got a separate birth certificate. If you sleep in that property or live in that property, you have to pay the limited company market rate rent, otherwise you are taxed on the benefit. It's different when you have got a furnished holiday let and you maybe travel down to renovate it or do maintenance work, but you have got to prove that you're stopping it only to do maintenance work and you are not getting a holiday out of it. So what are the next steps for a landlord? The first thing is to get advice. The answer for two landlords with the same 3 properties could be completely different depending on their own personal circumstances. We've had landlords with similar portfolios. One earns a lot more through their employment than the other, and the one has been advised to go through and incorporate. One might be looking to build their portfolio, one might be looking to retain at 3 properties. And again, the answer is completely different to each of those landlords. So it's really important you get advice that is tailor-made to your individual circumstances. The next step is to understand your portfolio. So that is to get underneath what properties you've got within your portfolio. So that is the difference between the value now and what the cost of the property was, the rental income on that property each year and the relevant costs, and the mortgage interest you're paying. So you can really understand the profitability of your portfolio and if any of the properties on there aren't making any money. The next one is to understand your goals. That's really thinking about what you want to achieve from your property portfolio. Personally, we are looking to build a portfolio that will give us enough residual income to fund our retirement. So that is why we're in the building stage and not the sort of stagnation stage. So how can we help at Spotlight? We offer a 15-minute complimentary call to potential clients. Now, at the moment, we are not taking on landlords with less than 3 properties or are not looking to build beyond 3 properties. But we can hold a 15-minute call just to run through your personal circumstances and sort of answer any general questions. We can't offer advice as a result of that call, but I can give you steering in the right direction. We offer a property planning service. That property planning service looks at your portfolio, it looks at the cost to incorporate, and it looks at the tax savings, and it will give you a payback. So it will look at what the most tax efficient format to hold your property portfolio is in. Part of that will be understanding what you're looking to achieve from your property portfolio, what your family circumstances. So if we are asking if you are married and about your children, it is not a pre-screening for dating. It is that we can understand what you are looking to achieve from your property investments. We can help with the SPV incorporation. Now again, getting the incorporation right at the start is really important based on what your goals are. It's very different incorporating an SPV for 2 partners that aren't married, aren't related, and are just investors together, to incorporating a husband and wife that are looking for a long-term planning exercise for their family. We can also help with ongoing accounts and tax returns for landlords. Now, the way we work with clients is a very fluid relationship. The way that we work with our landlords is very fluid. We look to work with them over a long period of time so we can help navigate and steer them in the right direction from a tax perspective for their property portfolio. I hope you found this video useful and wish you all the best with your property investment.